Yes,
we
sir.
would be talking about chapter number 9 of CFP2, that is risk management and insurance planning. Chapter number 9 is about need analysis. Earlier we had discussed about the three approaches. There are three approaches to calculate the amount of insurance cover required on an individual. First approach is the HLV approach, that is the human life value approach. We had discussed in our last session about how to calculate the human life value. Today we would be talking about the needs approach. What is the needs approach? In fact, there are certain disadvantages of the HLV method, human life value method. First of all, human life value, as we had stated, that human life value is the present value of the future earnings of an individual. We calculate the age of the person and we calculate how much earnings this person would be earning till his or her retirement age. And we calculate those earnings with a certain rate of interest. We calculate the accumulated value of the future earnings, and then we calculate the present value of those earnings in present day times. So that particular value is the human life value of the person. Now, in order to calculate the amount of insurance required by the person, we reduce any insurance which is presently on this person. So that would be the net insurance requirement on this person. So human life value, number one disadvantage is that we do not consider the effect of inflation. Though we consider the compounding effect regarding the rate of interest, but we don't consider the effect of inflation. Secondly, we don't consider that the person's earning would rise with the passage of time because of progression in the career, because of enhancement in salaries, etc., etc. We don't consider all those aspects. So sometimes it becomes an unreliable figure. Secondly, HLV figures also comes out to be a very huge value. In spite of the fact that we are not taking into effect the inflation cost, in spite of that, it comes out to be a big figure, which practically is not possible for a person to take insurance, because a person in any way has to meet his yearly expenses also and has to maintain his standard of living also. So another approach, which is called the needs approach, is said to be more practical oriented. As the name indicates, needs approach, it takes into consideration the various needs of a person, because the needs of different individuals could vary. So basically, needs have been bifurcated into two broad categories. One is, so needs, if we are talking, one are the capital needs, and the second needs are known as the income needs. Now, what kind of needs would come under capital needs? Number one, capital needs, maybe a person wants to make a provision to build his or her house. So maybe for some property of, for let's say, for house building. Capital need could be for higher education of the children. So one wants to have a particular fund to make provision for the higher education of the children. So let's say education fund, and these days it's not necessary that it should be a higher education fund, even for school going children, even for tiny tots also you need a huge fund these days. If you have, some person has got ambition that wants to get his or her child in a topmost school, so then education fund, maybe for higher education or for otherwise, higher or otherwise. Then it could be for any other, mortgage, as we had said, house, it could be for house, it could be for car, it could be for any other liability. Then in Indian context, if we are talking about, there can also be a need for a marriage fund especially for the children. These are some of the examples. And similarly, income needs. Income need is basically the family. You can say livelihood expenses, basically, in very simple terms. Family livelihood, to maintain the standard of living, basically, you can say. So those are the needs. Secondly, you need, when we talk about life insurance, the financial planner should also take into consideration that if the earning of member of the family is no more, then the family should also have a buffer to provide for the last survival income. For example, for the dependents or for the last survivor income, we call it, because it's life insurance. So in life insurance, we say that life insurance is not meant for just one risk, that is dying too young, but it's also for another risk which is said to be known as living too long also. What if this person has to live too long? So he has to provide a provision for his retirement years also. So there should be a provision for retirement income also, and so on and so forth. So these could be some of the funds. Now this would vary from person to person. So a financial planner really would ask the person what does he consider that this person will be having various needs. Then there could be another capital need fund, which is known as, we call it emergency fund. Basically, emergency fund, expenses arising after the death of the breadwinner of the family. So emergency fund could be the money which is involved in incurring medical expenses. Then emergency fund also includes, especially in foreign countries, they make provision for funeral costs of a person also. Although in India the funeral costs are much more than in a foreign country, in European countries or American countries. But here financial planners make provision for funeral cost of this person also. Then emergency, so I mean liquid cash and all. Then to weed out small liabilities of a person are also included sometimes in emergency fund. Small, cash loans taken by this person. Immediately you have to settle the bills of the person. So those all come under emergency fund. And then mortgage and liquidation funds, you can say mortgage funds or liquidation funds. Now these days in India also it's quite prevalent that people have credit cards, people have taken loans on their vehicles, people have loans on other appliances also. People buy their other appliances also on loan. What to talk about home loans or only car loans. Other things are also being bought on loans these days. So one has to make provision for this. Similarly, education and all. Similarly, in last survivor income, like we were talking that one has to, it's said that a good financial planning involves that one should provide for the family's income for at least 2 years after in case of the unfortunate demise of the breadwinner of the family. There should be a provision of 2 years income with the family. So those kind of liquid funds should be there. So with the family. And of course, last survivor income is also if the widow is there. So for example, in a particular family, not working, and so one has to provide for even longer term. One has to provide liquid funds for even longer term than 2 years. And similarly, like you consider the children are small, so you know ages of all of the family members also have to be considered. So by the time they will be able to stand on their own feet, they will be able to earn, so there will be a long time gap, so more liquid funds provision has to be made. So it will depend on family to family. And after that, after you have calculated these are the liquid requirements of the family, then you have to see what is the liquid money possessed by this individual on which the financial planning is being done. So in that case, you will take into consideration all the liquid funds of the person, cash in bank, cash in other, let's say fixed deposits, cash, money invested in shares, in mutual funds, or other property other than house. That we will consider. We will segregate the fixed assets from the liquid assets, and then we will deduct those assets possessed by the person from the requirements of the person, from the needs of the person basically. First of all, we have to calculate the different needs, then we have to check what this person possesses, and then we have to deduct the total needs of the person, let's say X amount. Now, liquid funds, it's a very simple method, possessed by the individual, which is say Y. So the net requirement would be X minus Y. So this requirement, let's say this X minus Y is Z. So Z would be should be the life insurance cover on this person. So here they don't consider what is the future income, how many years are left for earning. No, we just consider what are the needs depending upon the circumstances of a person and depending on the person's own revelations. Basically, the financial planner is not himself for jotting down some figure and telling that here you require this 50 lakh of insurance or 1 crore of insurance. This is, after the revelations of the person itself. Now let's see this example by a small example. Let's understand this concept by a small example. Okay, very quickly we will see this example now. Now there is a example given in the question also in our course, so we will take the same example. This question says that Amit is a person, is 34 years of age. The age of individual is 34 years. He is married and has one child. He earns 5 lakh rupees annually as a manager in a multinational firm. So annual earnings are 5 lakh rupees. His wife is 32 years of age, working, and child is 6 years of age. So while conducting his need analysis, it was estimated by the financial planner that cash needs. Now this financial planner has segregated his needs into cash needs. Number one, what are his cash needs? In the case of his death, for example, what happens if you, the financial planner would ask, if you are not there with the family, unfortunately, God forbids, if you are not there, then what do you think would be the cash needs required by your family? So he says that the family would need 50,000 for uninsured medical expenses. There are certain medical expenses, as you know, there is a medical insurance also. There are certain expenses which are covered by the insurance company. There are certain expenses which are not covered by the insurance company. So he anticipates that the family should have a fund of 50,000 rupees for such kind of medical expenses. Any family, in our families also, the elders used to say that we should have some money for emergencies, for any contingencies. We should not spend whatever we earn, isn't it? So he says that yes, his family should have 50,000 rupees as cash for such any kind of anticipated medical expenses, and anticipated or unanticipated expenses. Rupees 2,50,000 for car loan. He has a car loan, so in case if the person is alive, he would go on paying his EMI. But if the person is not there, immediately the family would be required to repay this amount, and all of a sudden the earnings stops. So one has to make a provision for this. So let's say 2,50,000. And credit card loan as well as plus credit card installments. Club together, the loan amount is 2,50,000. And these would be the immediate cash needs for the family. Besides the funeral costs. Now funeral costs also has been taken into consideration in this case. We'll add this afterwards. Then this financial planner has clubbed his other forms of needs into income needs. What would be the income needs for the family? Amit would also like to provide monthly income to the family during the readjustment and dependency period. Readjustment period, as I said, it's normally 1 to 2 years if the person, the earning member is not there in the family. So readjustment period and the dependency period of the children. Until his son reaches age 18. So after considering his wife's take-home pay also, because his wife is also earning, Amit determines that the family should need an additional 14,40,000 to meet the monthly income goal of the family during the dependency and readjustment period. Anyway, this is as per the client has said. So let's see how it is done. So income needs, total income needs, that is, are 14,40,000. He has taken into consideration the child is 6 years old, so until 18 years of age. So that is 12 years and hence. So this should be the income needs for the family. And then another needs have been clubbed under special needs. Amit would also like the mortgage on his home to be paid off if he were to die. The current mortgage balances. Now here the house mortgage has been taken under special needs. He also wants to establish an emergency fund of 2 lakh rupees for the family and an educational fund of rupees 5 lakh for the family. That is emergency fund 2 lakh. Now this emergency fund is different from this uninsured medical expenses fund, and an educational fund of 5 lakh. Amit has personal savings. Now these are the needs of the person. Let's see what are the personal savings of the person. Personal savings to the tune of 2 lakh rupees. He owns mutual funds and individual stocks with the current market value of 4 lakhs. Mutual funds, individual stocks, 4 lakh. Currently insured for, that is current insurance is of 5 lakh. So the question says, what are the additional funds? What is the additional life insurance cover required? Additional. We will just add up all these costs. Number one, let's add these costs. This is 3 lakh 50,000, right? This is 14 lakh 40,000. This is 5 and 2, 7. 7 and 5, 12. We'll add up all these costs. 29 lakh 90,000. No, this is as per the needs told by this individual. Okay. Now it's very simple. What are the personal funds owned by this person? 4 and 2, 6, 6 and 5, 11 lakh only. So it's the most simplest method. So we will reduce from this 29 lakh, 11 lakh, because we take into consideration the current life insurance also. Because in any case we are considering for life insurance. If unfortunately anything happens to this person, the family will get this 5 lakh rupees. So that's why we are considering that these are the liquid funds. These would be the liquid funds of the family. So 18 lakh 90,000 should be the additional cover. Now, since this insurance cover is being uncovered by the financial planner, it's being calculated by the financial planner. So financial planner can also suggest to this person that since you have high ambitions for your family, you also want to provide for an emergency fund, you also want to make a provision for educational fund. So besides, if this kind of insurance cover is possible for you, well and fine. This should be the appropriate insurance cover on you. But if it is not possible, then you should start investing in such funds so as to make provision for liquid funds. More provisions, you should do more savings. Let's say in PPFs and maybe in mutual fund, maybe in fixed asset, maybe in debt instruments or equity instruments. That will depend on the risk appetite of this person. But at least this person should enhance this amount of 11 lakh rupees. So this also the financial plan suggests. So basically this method says that very simply you should see, for example, if see what is the difference between this method and the human life approach method. Human life approach method doesn't take into consideration the family size of the person, the family background of the person. Even if the person is single, doesn't have any dependents on him, even then the life insurance cover would be the same. Or if a person has got say 10 dependents on him, then also the life insurance cover will be the same. But here, if the person, let's say, is a single person, there are no dependents and he doesn't want to, grow his family also. Now, in European countries, the concept says that if the person has no dependent, then they say that there is not much need of life insurance on this person. Why should he take life insurance? He should rather invest his funds elsewhere. So, so basically, all these requirements would not be there. Educational loan would not requirement would not be there. These kind of income needs would also be very small. So therefore, his insurance, life insurance cover would also be small. Several other examples also you will find in our courseware about this approach. So you just have to calculate. You have to segregate the various kinds of needs by this person, and then you have to see what are the liquid assets possessed by this person. Basically, we have another method also, capital retention method also. Normally, we don't take into consideration the value of the house in which the family is living. Whether they have any mortgage on the house or they don't have any mortgage on the house, it's not necessary. But if the person is living in the house, people say that, oh, I am living in a house of worth 50 lakh of rupees, worth 1 crore of rupees, whatever the cost may be. And I am a person of so many lakhs or so many crores. But generally, as per the sound financial planning principle, we should not consider that cost. Because till the person or the family is living in the house, you cannot estimate the cost of that house. The liquid money would only come once you sell the house. And while we are calculating the life insurance need on a person, we cannot say that okay, the family will sell off the house and then they would invest that money and they would run. I mean, that won't be a sound financial principle. A good financial planner should suggest that without parting with any of the fixed assets of the family should be in a position to continue their living. Thank you, participants. I hope you would have understood this concept, and it's a very simple concept. You just have to calculate the different needs in the examination. Thank you very much.